Eric Mwathe here. So let's continue here with the negative divergence, positive divergence idea here. And now we're going to go back to what happened in 2007. And this is the NASDAQ weekly chart. So we have a chart here for the NASDAQ weekly between 2006 and 2009. So what we're going to be looking at mostly is how we made this high here in the market in the time period of 2007, whether we had any negative divergence, and also we can take a look at this where the market made the lows of 2009, whether we had any positive divergence. So why don't we take a look at the high in 2007 on a weekly chart, and we see that we had a higher high on the weekly chart as far as the NASDAQ is concerned, but notice what we had here was a lower low. We made a lower low, and what's actually interesting is the fact that we made this higher high in price here, but the technical here was a lower low and also in the area around that 61.8 on the RSI. So that to me was a major tell, the fact that we made a higher high and the technicals did not make it as high as 61.8 or actually stalled in that area. In fact, had a reversal to really cancel out any move above 61.8. So you got bearish sentiment in the sense that higher highs, declining technicals, and also immediately back below 61.8. So I would even argue that was a reason why the market had a tough time. Now let's take a look at another aspect here, and it is if you take the lows and draw them like that. So this coming into late 2007, once we broke down here, which also happens to be this level here, the market had a major drop here. That's a big drop as far as the markets are concerned. But from this breakpoint, now you draw a straight line. Again, we're talking about from this breakpoint here on the RSI, draw a straight line, and you see once we formed a double top there, hope you can see that this double top or triple top formation happened to be these highs here, and once we moved back below the blue line here, that was a sell signal. So there was a sell signal here. We moved above the line and back below it in uniform action there, and that was the reason why that was a major high here. So it made sense that while we were in the bear market, this was an area where you had to actually recognize this as a short opportunity. And you can see it's only until the market would come back in 2009 and finally manage to clear that level above the blue line, which is this level here. So there was a change in sentiment, and probably one of the reasons why the market had a nice run. Also on the RSI, you'll see that we made a lower low here on a weekly closing basis, while you see that the technicals made a higher high, and you can see this here, we did not go below 30.90. So because we stayed above 30.90 here, and there was positive divergence, that's the reason why we get this sharp move in the market. And at least that's what I'm looking at. This, you got this going down, this going up. That was sufficient for this market to move higher. No, what I want to do right now is go back to this general area and take a look at the daily charts to see what we can learn as how the markets was trading in 2007. So we're going to begin by taking a look again at the NASDAQ daily, and this is a daily chart between 2007, or actually capturing 2007's daily action. And I want to go back to this interesting here that we made a higher high, and also notice that this was based on this previous daily closing high here. So that was an entry point, was a breakout. The market was breaking out here, and you can see the market would go on to make a higher high in price. But take a look at what the technical did, and you can see that is just falling in the area of the 61.8, somewhere around there. So that confirms the idea that I'm trying to teach here, is that as the market is making a higher high in price, a market, a stock, a currency, commodity chart, anything that is a trading instrument, the fact that you notice that there is negative divergence, and more importantly, I have to stress this, more importantly, if that negative divergence forms when the RSI is unable to move above 61.8, so this general area, then this becomes a major high. It's more powerful when the rejection is at 61.8 and yet prices somehow manage to make new highs. That would be, for me, the reason why you have this market here immediately turn around and immediately have this drop in November of 2007. And we'll also notice that after this resistance here, this red area, so after we break down here to a straight line, you can see we came back here and eventually would be rejected here. And this was the highs before the market dropped in 2008. Now let's go take a look at what the S&P 500 was doing in 2007 here. So this highs here, and you'll see that I don't see a major sell signal here but you can argue that the market made a higher high, but the technical picture did actually improve, so that does not work. But I'll show you what, when I was looking at this, what my reasoning here would have been from a sell point. Take note of the fact that if that was a breakout, and so if this was a buy point here as a breakout to new highs past the previous highs, we went above this and down below that in almost uniform action, and again we were rejected here. So we broke down here, came down, touched the 50-day moving average, bounced back to this general line, and we got rejected. So at that particular point, you realize that the market is actually running out of steam, and this is not a strong setup. Again, rejection here, failed breakout, and this also now turned into resistance. Also, another way to take a look at this is if you draw a straight line and actually touch that high there. So that was a break, and so you take that level here, which is the break level, draw a straight line, and you see that it perfectly explains this high, because that was rejection, which was this high, and a major almost 20% drop in the market. So that's a nice time to go short. We come here, we try and move above this red area, but we are rejected, and so this, at this break point back below the red line, this becomes a sell point, and it is at this point here. So also notice that this again was rejected here, which happens to be this high. So all the things that we are learning here about negative divergence, where to draw the resistance levels on the RSI, resistance levels in price, all these things make sense in explaining why the market looked a little bit questionable coming into late 2007. Now we take a look at the Dow, and the Dow has a similar chart to the S&P 500 here. This was a previous daily closing high. We break out here, we go up, we come back and test the red area, and then we make new highs, and then eventually we are back below that. So once you have a failed breakout, then you have to be cautious. Eventually we'll bounce off the 50-day moving average, come here, get rejected here again, and move lower. So that was another sell point there. I look at the RSI, and you can see that there was a break somewhere around here, right? You see that was a break point here on the RSI, which was major reversal here because the market had a big drop. So you use that information and draw a straight line from the break point here, and so it would be something in that general area. So every time you stall, like we stalled here back below the red line, that is going to tell you what the highs. It's a time to get out. We stall again here, which was this high, and we stall again here, which was this high, and the market would go on not to see these levels. In fact, the market would trade lower for 2008. Let's take a look at another chart here. Actually, that's it for now. Let's take a look now at 2000 coming into 2000 to see whether we can see how the market was looking like in 2000, so we can explain the RSI negative or positive divergence. Now, this is the NASDAQ chart going back to 1999 to 2003, and I want to take us look here in this March 2000 highs when the market made a major high on the NASDAQ before this drop. So I want to go back to the daily charts here just to see whether we have any kind of negative divergence that would have helped investors recognize that this was a major high. So let's go to the charts here, and we're going to begin with the Dow in 2000. So this is a chart between July of 99 and May of 2000, and you can see that yes, we had a higher high on the Dow coming into the early part of 2000, and we had a lower low on the technicals, and this was a major high for the Dow in that time period. Again, we are talking about on the weekly, we are talking about this time period here, this general area where the market made a major high. Oops. So we are talking about this general area where the market made a major high, and so the daily for the Dow look like this. Again, we have higher highs, lower lows right there. And also we can see that if we draw a line like that, okay, so now this becomes, this break point there is important, so we draw a straight line like that, and you can see rejection here, which is precisely at the high, and you get this major drop here, and then you come back here, you try and hold above the line, eventually you get rejected there, which is this major high on the Dow. Let's take a look at that particular time period. Take a look at the S&P 500. This is 2000, and you can see on this chart there is no negative divergence because we made a high here. Okay, so the market made a high, but yet when you take a look at the RSI, really it was still at the same level on the RSI, so that was not negative divergence. But if we go back to the method here, which is how to read the RSI and how to use the RSI to tell you what's going on, is you just look for the breakpoint, draw a straight line, you'd draw it something like that. Okay, that's one way you can draw it, and so you just take a straight line like that, and that straight line you can see here when the market was making this high, you have uniform action above the blue line and back below it. Does that make sense? So you basically just went above the blue line and back below that, and that's what I call uniformity, and that tells you that that is a trap. And so this becomes a high once you move below the blue line here, and you can see here we tried to move above the blue line and failed, which also happens to be that high. It's a very precise method, and that would have been enough to tell you that the market was turning around, and you need to be very careful. And after that, you see we had this major drop. Actually, if you extend this, and you'll see that there's another breakpoint, which is here, right? Because once we broke down here, happens to be somewhere around here, and the market had a major drop here. So from this breakpoint here, we draw a straight line, something like that, and you can see even here, when we got rejected at that level there, happens to be this major high on the S&P 500. Now let's take a look at the NASDAQ coming into 2000 or March of 2000. And on the daily here for the NASDAQ, what I see is the market was trying to make a higher high there, did not close to new highs here, did not manage to close at new highs there, At the same time, you see that the technicals were not very strong. So the market was trying to make higher highs. Technicals were not very strong, even though you cannot technically call that negative divergence. Why? Because you need a close above the previous high. You need a close above this. Let me take that off. For this to be true negative divergence, then we needed a fresh high close, but we did not close above that high. So I can say, or I can argue here, that this was not negative divergence, and it's not always going to be perfect, but at the same time, this was also making lower lows, not very strong. What I can tell here is that there was a major break. This line here that I'm drawing here in blue, right? Because on the way up, this was support here, nice entry point, was support here, nice entry point, was a double bottom support here, which is this low for a nice move. And so once we broke down here, draw a straight line, and even though you might have missed, let's just say you did not recognize this was a major high, by the time you break down here, which is again below this support line, you know that something has changed. And notice that if you draw an extension of this breakpoint, which is around the 50 on this particular chart, you see that resistance here happens to be this high. Resistance here precisely tells you this is a high, and another resistance there tells you that this is a high. And the market eventually would go on to make amazing bear market lows going into 2001, 2002, and 2003. So you can use negative divergence to at least give you an idea of where the market is going short term, or if a market is making a major high. Eric Moade, good luck, peace, and blessings. Mwah.